Our first speaker this afternoon is Mick Keogh. Mick grew up in southern New South Wales. After obtaining a bachelor's degree in wool and pastoral science at the University of New South Wales, he managed a beef cattle research station on the New South Wales North Coast for several years. He was subsequently employed as a researcher at the University of New South Wales, where he completed his Masters in '84. Over the next 8 years, he was employed as an agribusiness consultant, participating in a wide range of industry and government-funded consultancy projects, often as the lead researcher. In 1992, Mick joined the New South Wales Farmers Association and was subsequently appointed General Manager of Policy. In this position, he was closely involved in a wide range of issues impacting on the farm sector at both state and national levels. In late 2003, Mick was appointed Executive Director of the Australian Farm Institute. The Institute is an independent organisation which was established to conduct research into public policy issues impacting on the Australian farm sector. The Institute also promotes policy solutions that maximise the economic and social wellbeing for farmers. Mick Keogh.
Thanks very much for that introduction. I'm always a bit nervous talking in this area of the world because too many people know me and are familiar with all my weaknesses, so I can't get away with dodging. I guess in talking about future sustainability and where agriculture might be some time into the future, the issue of carbon frequently comes up, and it's certainly been a fairly steady topic of conversation over the last few years. And the question is frequently asked whether there's anything in this whole carbon issue from a farm business perspective. So what I'm aiming to do is talk through a range of aspects of the issue. Firstly, in a sense, we're talking about a new market, and that market is created by the government's policy on carbon. So it's important you understand a little bit about the carbon policy and a little bit about the nature of carbon markets and prices. Then I want to look at just a couple of case studies. They're really just scenarios that give you some sense of what the thinking is and what you might need to think about if you're anticipating getting engaged in it. Then look at some of the implications from a farm business perspective and just finish up with a couple of key messages. So to start, I'm sure all of you are aware that carbon's the most plentiful element in the biosphere, and it's present in a range of different pools. So it's present in the atmosphere, it's present in vegetation, in soils and in water. And we're told the problem is there's too much of the carbon from decaying vegetation, from emissions from animals, from fossil fuels, adding to that pool of carbon in the atmosphere and creating a warming effect and changing climate. So that, I guess, is the focus of a lot of the discussion about the market for carbon. But of course, there's another side to that cycle, which those in agriculture are quite familiar with, that processes like the growth of vegetation, the vegetation encompassed into the soil, the carbon in pastures that becomes animals or goes into crops, and so it's all part of a cycle. So it's quite important in this discussion to recognise that there's two sides to that carbon equation or that carbon cycle, and agriculture is involved in both of them. And if you want to solve the problem of too much carbon in the atmosphere, there's two ways to do it. One is via mitigation, in other words, slowing what's going up, and the other is by sequestration, speeding up what's coming back out. And agriculture is involved in both those. So in the discussion about carbon markets and carbon trading, it's important to realise that agriculture has a role in both sides of the cycle. Agriculture can be important in terms of mitigation, changes that reduce the amount of carbon going into the atmosphere, and it can be important in sequestration, locking up extra carbon out of the atmosphere and reducing the atmospheric pool. So just keep that in mind on the way through. And in fact, the government's legislation is pretty much structured around that same thing. So the Clean Energy Futures legislation is the legislation that aims to reduce emissions by requiring large emitters to pay for an emission permit called an ACCU. Get used to that, an ACCU, an Australian Carbon Credit Unit, for each tonne of emissions they produce. So that's basically how that legislation works. Then the Carbon Farming Initiative aims to create incentives for farmers to undertake projects that abate the amount of carbon in the atmosphere, and the incentive created is that farmers earn a permit for each tonne of abatement they are responsible for. So these permits basically become the new currency of the carbon market, and obviously those emitters that have to buy permits will be in the market for the permits that are able to be generated by farmers participating under the Carbon Farming Initiative. So that's how it all stitches together, I suppose, is a simple explanation of the policy. But there's 2 points about a carbon market that everyone should understand before they get involved. The first is that there's no such thing as a carbon emissions meter. Now, the reason that that's the case is that greenhouse emissions consist of up to 6 different gases, not just a single gas. So even if you could put a meter on, you could only probably measure 1 or 2 gases and not the whole combination of them. So basically what has evolved is this common unit that people talk about, and you'll see that symbol there. Now, that doesn't refer to carbon dioxide. It refers to a carbon dioxide equivalent. And so if you look at, for example, burning a litre of petrol, it produces 2.3 kilos of carbon dioxide equivalent emissions, some of which is carbon dioxide, some of which is methane, some of which is nitrous oxide. So a combination of different gases, and they're all converted to the same units by factors that relate to their warming potential. So it's quite important to understand, and this becomes important in soil carbon because you saw in that discussion before, Phil was talking about tonnes of soil carbon. And when you're talking about the carbon market, you're talking about carbon dioxide equivalent, and each tonne of carbon, for example, in the soil means you've removed 3.67 tonnes of carbon dioxide out of the atmosphere, because of course the weight of the carbon in the atmosphere includes the weight of the 2 oxygen molecules or atoms that are part of it as well. So I know that's going to confuse you, but just be careful in the discussion to understand that when you're talking about carbon trading and carbon markets, you're talking about carbon dioxide equivalents, even though everyone just uses the shorthand carbon. So it's not the same as carbon in soil. So just keep that in mind. But the key factor is you can't actually measure it, so the way it's calculated is based on these standard calculations that are, and you can go to websites and look at them, but basically instead of putting a metre on a car to work out how many emissions are produced, they know that for each 1 litre of petrol burnt, there'll be 2.3 kilos of carbon dioxide equivalent emissions produced. And so that's how the system works. It doesn't work on measurement, it works on calculations. The second bit is that it's a market created by governments. We've already discussed that. And so it brings in an element of risk that's not present in most other markets that farmers deal with. And that's what's called sovereign risk. And that is the propensity of governments to change their mind, or in fact governments to change. So that's an element of risk in this market that is distinctly different from most of the other markets you might be used to. So you need to keep both those things in mind when you're thinking about how the carbon market works. Okay, so that legislation is going to impose a cost on those businesses that produce large amounts of emissions. The government has said more than 25,000 tonnes. And if you look on the government's website, www.climatechange.gov.au/NGRS, National Greenhouse Reporting Scheme, you can see the returns from all these the companies. So since 2008, any of the larger companies have had to put in an annual greenhouse and energy return. And they've used those standard calculations I was talking about before to estimate what their emissions are. And so if you look at these companies here, this is pulled off the 2009-10 returns. AJ Bush, that's a major meat processor and renderer just outside of Sydney, 109,000 tonnes of carbon dioxide equivalent emissions. And you can see the list goes on. And I've quite deliberately pulled out companies that are involved in agricultural supply chains, so you get some idea of some of the businesses that are included. It's not just the big coal-fired generators. And the government has said that those permits that they will need for each of those emissions will cost $23 from 1 July this year. So on that basis, that's the additional cost to those businesses, driven by the fact that they have to now buy permits for these emissions. And so that gives you some sense of the financial impact, if you like, on the supply chain that a lot of agricultural businesses are involved in. Now, some of these businesses will get free permits because if you're involved in export or in businesses that have import competition, up to 95% of those permits that you require are free to start with, so that would reduce those numbers quite substantially. But it is important to understand that this is the list of companies, and these companies are going to be the ones that are in business looking for those permits that we've been talking about. They're going to have to buy them or obtain them somewhere. Okay, so that is going to have an impact on costs in the supply chain that farmers are involved in. The costs are going to come at two levels. One is at the farm level and the other is in the supply chain. And there's been quite a bit of modelling done of average farm businesses of all sorts of different types based on ABARE data, and looking at what the likely impact is on farm costs and what the likely impact is on the post-farm and the pre-farm supply chain. And so this gives you some sense of the likely cost impact that the carbon price will have. And this is after 3 years, when on-road transport emissions are anticipated to be included in the scheme as well. I guess the main message, two main messages to bring out of this. One is the farm level cost impacts won't be all that substantial, about 0.5% on top of total input costs at the moment. So not a huge big number, obviously adding to that pressure that's been talked about in terms of the requirements to keep up productivity, but not a showstopper. Some supply chains, though, do have substantial costs through the supply chain, and a fair bit of that is likely to come back to the farm. If you look at the dairy industry, for example, particularly where the production is for dried milk powder, it's basically using a huge amount of energy to boil milk and produce powder. That energy is going to cost more, and in many cases those manufacturers actually burn coal for their boilers, and that creates emissions, so they've got an emission cost. So you can see that in the dairy industry, for example, there will be more costs coming through. The rice industry is another one. The rice processing mills are located in two locations where there's no alternative energy sources other than electricity. So they're going to bear the full cost of electricity unless they can find some other technologies. So you can see that those supply chains that have got a lot of energy involved in them, and even sheep in New South Wales, where a lot more sheep there are turned off for slaughter, according to the ABARE numbers, than is the average. So that, and this assumes that the farm business doesn't do anything. And I guess that's a reasonable assumption in the first year or two, but over time you would obviously adapt and change energy use to try and avoid those extra costs, as would the processors. So I guess not a showstopper, but another source of pressure in terms of farm profitability. Okay, so to understand how the Carbon Farming Initiative works, let's look at what the emissions trading scheme will look like. So as I've already discussed, the government will set the rules about who has to be involved, so businesses that produce more than 25,000 tonnes, and that doesn't include any farm businesses, so no direct involvement from farm businesses. The emission target, and I'll talk a little bit about that in a second, the numbers of permits that the government will make available each year, and the rules about who has to participate and all those sorts of things. So those companies that are caught, if you like, in that net will now have already been estimating their emissions for a number of years. And of course the first thing they would do is see if they can find ways to reduce them. If not, they've got three choices. They've got the permits that the government's going to make available at $23. They've potentially got permits from Carbon Farming Initiative projects that farmers earn that they will sell, and they've potentially got permits from international offset projects where it's a similar sort of an arrangement, but they're permits that are generated internationally under the United Nations rules rather than in Australia. Now, there's a limit on how many of those international permits those companies will be able to use to start with, about 5%. But I guess what it highlights is that these companies will be looking for the least cost way to get enough permits to cover their emissions. And if the farm sector is able to provide those permits through projects at less than $23 or even just slightly less than $23, obviously that will create the demand for those permits. So those companies might have a situation like this: 30,000 tonnes of emissions. We've bought 3,000 permits from projects run by farmers. We've bought 10,000 permits from projects overseas. That leaves 17,000 tonnes of emissions we need permits for. Therefore, they'll go and buy 17,000 of those government permits. So that's basically, from a company's perspective that's involved in the scheme, that's how it works. So they would then go and buy those permits. They would do their return at the end of the year. They might have had a busier year than they thought and produce more emissions, in which case they'll have to go into the spot market and buy more permits. Or they might have had a quieter year and they might have spare permits to sell back into the spot market. So you can see there'll be a spot market, if you like, as well as a market for longer term supplies of permits. And then they'll continue that cycle on. And what will change after 2015 is it'll become a true emissions trading scheme, because instead of a fixed price for those government permits, what the government will do is shrink the supply of those permits. And obviously that will drive the price up and create more incentives for those businesses to reduce emissions. So that's basically how it works, and you can see how carbon farming initiative projects and the permits that they are able to generate fit into that system. But let's have a look at carbon markets to start thinking about it. And the first point is that not all carbon's created equal. Going back to where we started, remember I said that what's counted and what's not and how it's counted is all determined by these rules. And a quite important one from our perspective is what types of projects generate permits that would be acceptable into the mandatory carbon market. And the ones that generate permits that are suitable for the mandatory carbon market, that is the $23 official one, are from eligible forestry. I'll talk a lot more about that. Reduced emissions from livestock and nitrogen fertiliser, so that's where you apply a technology that reduces known emissions from those sources. And avoided deforestation, where you've got a plantation or an area of timber that you have a right to clear and you decide to forego that by selling that right to someone else. So those sorts of projects generate permits that will be able to be sold into the mandatory market. Soil carbon isn't. Australia doesn't count soil carbon in its national inventory of emissions. The government has said it will recognise soil carbon offsets and provide permits for them, but they'll be different permits. They'll be permits that you can't put into the mandatory carbon market. Now, the market for those sorts of permits will be individuals, for example, who tick the box on their air ticket and offset their emissions, or companies that want to make carbon neutral claims, or the government has said it will buy some as well. But the important point is these are going to sell at $23, at least for the first 3 years. The market for these is somewhere around $3 to $5 if you're lucky. So there's a dramatic difference in the value of permits generated from, for example, a soil carbon project compared to any of these other sorts, and that's quite important to keep in mind. So let's have a look at what the price of carbon looks like in an operating market. In this case, it's the EU emissions trading scheme that started in 2007. And there's a couple of pointers to take out of this. The first one is you can see that the price obviously fluctuates. So even though we're talking about a fixed price scheme here, once it becomes a floating price scheme after 2015, it's like any other commodity market. The price will vary. The second point to take out of this is you can see the impact that that sovereign risk has. So under the European scheme, there was a big excess of permits made available in this period. That drove the price down pretty quickly because some governments changed the rules. It then stabilised in the next phase of the scheme, and then of course in mid-2011, once the economic conditions turned worse, those businesses that were previously making emissions and selling things stopped doing that, and that drove down the demand for emissions. They didn't need as many emission permits, and therefore the price dropped down. So you can see that in many respects the carbon markets, like every other commodity market, the price goes up and the price goes down for a range of different reasons. This second graph shows the relationship between the EU carbon price and the international carbon price. And it shows you the blue one's the EU price and the red one's the international price. They're certified emission reduction units. And what you can see there is they tend to move together. And that's because companies in Europe can buy a certain proportion of those international permits for their offset requirements, for their permit requirements. So they operate at a discount, so that green line shows you roughly the discount those international permits were to the European carbon price, and that's partly driven by the fact that the rules specify how much of these permits these businesses can use. So it just gives you some sense that carbon isn't a fixed price thing, it moves around quite a lot, and it's internationally traded. So like every other commodity we produce, it'll be the international market. And certainly if you look at the pattern in the New Zealand carbon market, it responds very closely to the international carbon price. So it's like wheat, it's like beef, it's like everything else we sell. That'd be great. It's an internationally traded product, and that's where the market price is set. The reason that the international market is quite important to Australia is summarised in this graph. So the government, in its modelling, identified that emissions are currently about 600 million tonnes per annum nationally, and given population growth and energy use, it was anticipated that they would be about 1,000 million tonnes by 2050. The government has said its target is this red line, so a 20% reduction in emissions by 2020 and 80% reduction in emissions by 2050. According to the government's modelling, though, the carbon price it's put in place on its own will only slow gross emissions in the economy slightly, and they'll slowly start to come down after about 2030. So that's well short of this target. So the way that target's going to be met is with those extra permits, particularly the imported permits from overseas, up to 400 million tonnes of them by 2050, according to the Treasury modelling. And some of these will obviously be permits generated by carbon farming initiative projects. But I guess it highlights two things. One is that Australia is going to rely a lot on those international credits or international permits to meet that target, and that's why the international rules are quite important in terms of accounting. But also there is going to be quite a demand for permits over time, and that will create demand for the sort of permits that can be generated on farm under the Carbon Farming Initiative. Okay, let's have a look at a couple of case studies just to get a bit of an idea what it might look like at a farm level. Firstly, under the legislation, basically what the Carbon Farming Initiative does is set a series of methodologies, a series of, if you like, rule books for different types of projects. And so once those methodologies are in place, you can pick those up and apply them. So they're a bit like a quality assurance scheme, I suppose, is one way of saying it. They have some characteristics that are quite important, and I'll just explain them briefly because you'll see where the rules come in as we go through. So additionality, you don't get a credit for doing something you're already doing. You have to do something extra. So if you're already growing trees, you don't get any credit. You have to grow more trees. If you've already got higher levels of soil carbon, you don't get a credit. You actually have to increase your level of soil carbon to get a credit. So it's quite important to understand this additionality concept because that's one of the key requirements. And the second one is permanence. So if you're involved in that sequestration side of the carbon cycle that I showed you, where you're locking up carbon out of the atmosphere, you have to be able to lock that up for 100 years. Right? So the rules are that if you're going to get credits for growing trees, those trees have to stay there for 100 years. In other words, the rule is that that carbon has to be permanently removed from the atmosphere, and permanence is regarded as 100 years. So that's quite an important concept. Then the other rules are around things like leakage. In other words, you can't get a credit for doing something good on one part of the farm if you actually do something else on another part of the farm that increases emissions. Scientific validity, measurable and third-party audited. So again, it's not like some of the other programs that the governments have where they give you the money and forget it. In this case, it's got to be regularly audited before you keep getting the permits and therefore generate the revenue. So let's look at a plantation, for example, a single species plantation. So this is how it will work. For a start, it has to be on land that didn't qualify as a carbon sink forest on 1 July 2007. So a carbon sink forest is an area of land, and you can remember this, the 3 2s. More than 0.2 hectares in area, trees on it more than 2 metres high, and trees equivalent to more than 20% of the ground cover. Okay, so 0.2 hectares, 2 metre high trees, covering more than 20% of the ground cover with their crowns. So land that meets that definition, or did meet that definition on 1 July 2007, isn't eligible to be put in as a project under the Carbon Farming Initiative if you're growing trees. So it has to be land that didn't meet that definition on 1 July 2007. So that's the first bit. The next bit is if you're in a high rainfall zone, you actually have to buy some permanent water entitlements depending on how many hectares you're going to plant. Now this applies to single species monoculture plantations, okay, so blue gums, pine, etc. It doesn't apply to mixed species biodiverse plantings, okay, but if you're above 600 mil rainfall, you have to buy 0.9 megalitres of permanent water entitlement per hectare of trees planted, and it has to be above 80% reliability. So you have to actually buy a permanent water entitlement equivalent to that amount of water each year and not use it from then on. And obviously the higher the rainfall, the greater the water entitlement that you have to buy as part of the project. So that's something you need to keep in mind if you're above 600 mil, which obviously is certainly east of the highway. I don't know how far west that goes. Having covered that, you would then plant the trees. After year 3, and certainly before year 5, you can have someone come and audit them, and once the report's accepted, these permits will appear in your permit account, just like a share trading account. So there'll be a register with numbers in it that indicate you own that many permits. That obviously continues as the trees grow, and the typical crediting period for these projects is 15 to 20 years. There's some flexibility around that, but that's roughly the sort of numbers. So while those trees are growing, you can see your permit account keeps ticking up as time goes on, and obviously you could leave those in your account if you think the price of carbon is going to go up, or you could sell them if you wanted to generate revenue from them. That's a decision you would have, but the main point is that the project will be generating those permits. Of course, once the trees reach maturity, remember we said you had to maintain them for 100 years, and that audit requirement continues every 5 years. So those trees have to stay there, and you obviously don't generate any more permits once that plantation's reached maturity and stop locking up any more carbon. If you decided to cut them down, then you have to pay back the permits. And of course, if the price of carbon's gone up, you could in fact be in the red in your permit account because you've had to buy more permits back at a higher price than you earned on the way through. The government has said, however, if it's a natural disaster, a bushfire, disease or drought is the reason the trees die, you don't have to pay the permits back, but of course you don't generate any more permits until you re-sow the trees and the stock of carbon in those trees exceeds the maximum that you've been credited for up until that point in time. So obviously the issue of insurance and disaster risk management is obviously something you need to think about. That's, I guess, an example of a plantation where you're intending just to leave the trees there. The opportunity also exists to harvest the timber, and you might do a harvestable timber carbon combination for cash flow advantages. The way it would work would be like this. So you might plant the trees, trim them on a number of occasions, and then have a substantial harvest of a fair bit of it at some point in time, 20 or 30 years into the future. The way that it would operate is that you would earn permits on the way through equal to an average for the minimum amount of carbon that was going to be there at any one time. So if you're involved in the rotation here, say you harvest 20 hectares of, say, 80 and do that every 4 years and replant behind it or whatever, then that's the way that that would work. So you can see that the advantage this might bring to you in terms of a plantation is that you'll have some cash flow coming through even before you get to the first harvest or whatever. So the New Zealanders have already developed some quite interesting models of plantation, particularly for high-value timber, where they can use the carbon revenue to offset the establishment costs in the early stages of the project, then use the timber revenue at the end to pay back those carbon permits and close up the project. So there's no methodologies for that as yet, but that's the sort of model that might evolve. Soil carbon was talked about before. Phil talked about it. Exactly the same as a tree plantation project. Permanence requirements apply. So it might look like this. You might have started cropping. You've reduced soil carbon down to that sort of level. You might then say, all right, let's go back to permanent perennial pasture. You would do that, you would get a recovery in your soil carbon levels, and that would reach a new equilibrium. And of course, it would need to be maintained with fertiliser on the way through, etc. But exactly the same rules apply. You've sold that carbon, so the difference between there, your baseline, and whatever your soil carbon level is, you've sold that carbon to someone else. And part of that sale contract says you'll keep it there for 100 years. So it has a permanence requirement. And of course, the scientists would tell us that if you got sick of the perennial pasture here and decided to go back to cropping, you'd have a fairly substantial drop in that carbon in the first year. And of course, that has implications. So certainly needs thinking about. Now, those issues apply to sequestration projects, so where you're locking up carbon out of the atmosphere. When it comes to mitigation projects, for example, up to 3% oil in a dairy cow's diet reduces methane emissions by up to 10%. If you went down that track, you could apply that particular methodology, that particular project for a year. As long as you met all the paperwork requirements, you'd generate the permits from it. If you looked at it again the following year and said it doesn't make sense, then there's no carbon penalty associated with it. You've gained the credits for the mitigation that you achieved in that year, and then you decide the next year whether you're going to do it or not. So the same might apply to a piggery, for example, where you put in a methane capture project over the manure waste plant. But that is the important difference between a mitigation project and a sequestration project. Mitigation project, you're stopping that level of emissions for a particular year, and that's what you get credit for. A sequestration project, you're undertaking to lock that carbon up for 100 years, and so you've got to keep it there. Okay. There'll obviously be some transaction costs associated with these projects. It's not a matter of just putting your hand up and saying, send me the permits. And we've done some modelling here, and I'll just go through it fairly quickly, but they're the sort of costs you might be thinking about would be part of the transactions. We did this modelling on the government's carbon projection. Of course, as you saw earlier, that's not necessarily what the price of carbon will be like into the future. So on this one, 2,300 hectare property, decided to plant 10% of that to trees, 5% each year, about $2,200 a hectare planting costs, assuming some losses, and an audit every 3 years. So that's what the cash flow looked like from that project. So you can see there the red bars are the costs, quite a deal of cost in those first 2 years. You're sowing down 100 hectares of trees in both those years, and then you've just got those ongoing auditing and administration costs. Start to generate revenue, which is the blue bar, and of course your net returns, if you like, look something like that. So unlike most forestry projects, by year 3 or 4 you're actually already into positive cash flow, and of course as the trees grow and the price of carbon goes up, presumably, the revenue generation is quite positive. So that's what that sort of project would look like from a financial perspective. If we looked at the soil carbon, same size property, assuming they're sowing up to 50% of the property down, one of the real issues with soil carbon is testing. You have to do a baseline test, in other words, establish what your soil carbon levels are to start with, and then you would need to resample them at least fairly regularly, because of course you only generate permits once you put in the testing that demonstrates that you've locked up carbon. So to generate the revenue, you've actually got to do the soil testing again. And the LECO soil test is about $103 a sample, or it was last year. And you'd probably have to do at least a sample every 4 hectares, and probably the whole farm, in fact, to prove you weren't reducing soil carbon somewhere else. And I think, as Phil said, you don't just lock up carbon, you lock up phosphates and nitrogen and all that. So you would need to maintain that pasture to keep that soil carbon ticking along. The rate we used in this modelling was about 2 tonnes of carbon dioxide equivalent per hectare per year, which is the rate DPI at Wagga in a 20-year trial was able to achieve in the switch between a cropping rotation and a permanent pasture. So considerably less than the trees. The trees, single species, blue gums, 25 tonnes CO2 per hectare per annum. So, and you can see here that this project never gets into positive cash flow. You've got always this soil testing cost, and you've got the pasture establishment costs on the way through as well, and you're always in the red. And of course, that's a bit deceptive because you're grazing that, and you know, it may be part of an integrated grazing operation, but certainly the standalone soil carbon project, particularly at the $5 a tonne, and particularly at only sequestering 2 tonnes per hectare per annum, just never got into the black as far as that modelling was concerned. So let's think about it from a farm business perspective. There's a range of different modes of engagement in this system. You could be a direct participant. You could do the project yourself on your own farm, end up with those permits in your account, and go and find someone to buy them. More likely is a broker aggregator model. That is where you're paying a broker either on a commission basis, on a share credits basis, much like share farming, or on a service provider basis. So, for example, a consultant who you're paying dollars per hour to do all the paperwork and administration. Emerging quite quickly is a land lease arrangement, and that's where the landholder's engagement is simply to agree to a perpetual lease of the land and have someone else manage the project. So in that case, it's basically just down to a lease rate per hectare, and that's the only involvement you have in the project while everything goes well. And the other one is a pool credits arrangement where you might have a group in a catchment, each with small amounts of credits, but if you put it all together, it works into a reasonable number, and there could be some arrangement there. Having a look at these, there's obviously pros and cons associated with each of them. The pros, in direct participation, you'll obviously be able to get started using your own labour, and that'll save money, but there is high initial costs involved in a lot of them, and it's not immediately tax deductible. And that's an important point to know. The tax office does not regard carbon sink forestry income as primary production income. They regard the expenses associated with start-up of one of these projects the same as they regard expenditure on a capital item. So in other words, you can depreciate those expenses at 7% per annum over 14 years, but they're not tax deductible in the year that you incur them. So that actually, why that decision was made, I don't know. If you actually set this project up for forestry, the different rules apply. Forestry is regarded as primary production income. You can deduct all the expenses in the start-up year against your other income, but it's just something to keep in mind. Managing it yourself has pros and cons. There's a whole range of those issues you need to think about. If you go to an aggregator who shares the credits, the aggregator obviously has a lot of responsibility on the way through, and that takes some of the risk out of it. But the issues are whether you know you're getting a reasonable return for it, and you also don't necessarily know what the value of those permits is going to be long term. So where an aggregator, for example, might say, well, I'll run the project, but I'll take 40% of the permits and you have the balance, as the aggregator might be saying that as their operating costs. The issue with that is you don't know what those permits might be worth into the future. And another model is the land lease arrangement. I think obviously the land lease arrangement is much simpler. The main issue, I think, comes in here, because once this project is established, part of the requirement is that it becomes a caveat on your title. So the Land Titles Office will have a note on your title, the same as it does with a mortgage, that says there's a project on this area of the land and it has an obligation to be maintained. So if that aggregator who's leased the land off you subsequently goes broke, that carbon obligation stays with the land, even though the aggregator's disappeared. So there's an issue that you need to think carefully about in entering into those sort of arrangements, because you're taking on the responsibility to maintain that carbon longer term. So these are some of the things you need to think about. I guess the key messages from my perspective is, look, a carbon price will have a negative impact on farm and agribusiness profitability. It's not a showstopper, but it is going to produce more pressure, if you like, on profitability, and it's something you need to think about. Carbon Farming Initiative may provide an opportunity to generate some revenue that offsets that. There's a lot of risk associated with them because, of course, we don't know what the rules are, we don't know what the government might be in 2 years' time, so that's something to keep in mind. It's a new enterprise, so don't go into it thinking, well, this will be pretty straightforward. When you look at the paperwork associated with those methodologies and what you're required to do, it's a new enterprise, so I'd approach it as such rather than just assuming that you'll be able to make money out of it. Sequestration projects have those specific issues of permanence that I've talked about. It's a permanent change in land use unless you're prepared to pay back the permits at some stage. And the government's role in creating a market for the soil carbon offsets isn't clear yet. They've said that they will have some sort of role in that and be buying some of those, but we don't know what price. So I'm fairly negative on soil carbon projects at this stage because I just can't see the sequestration rate or the price being sufficient to make the costs worthwhile. There is an online tool that you can have a look at. You basically set up a farm, model it, play around with different scenarios. It's available on the Farm Institute's website, and you can save your farm there and play with different scenarios in terms of numbers, and it's got all the official calculation numbers in there, including for trees, etc. So it's a useful way to think about these sort of projects without actually having to get started on one. And that's about it. You're now experts in carbon trading.